to today's high-level talks between the U.S. and China, conflicting messages around the state of those talks, the state of the relationship between trade negotiators. And as you just heard there in the headlines, in terms of the latest from China, they have urged the U.S. to stop putting, quote, unreasonable pressure on Chinese companies. So a little bit of a cautious signal in the latest comments around those trade talks. Now, in addition, of course, keeping a very close eye on Brexit, with Prime Minister Johnson meeting Leo Varadkar for further talks, but hope certainly fading around the prospect of coming to a deal. But the overall message here, European stocks trading lower this morning. Let's take a look at the different markets and see what the regional split looks like. Red across the board, but the CAC 40, the French index, holding up best among the major regions, flat at the moment. Now, what's holding in France in particular? Luxury. Luxury is the best performing sector this morning, and that's been on the back of a strong set of results from LVMH aftermarket yesterday. But beyond France, we're looking at red across the board. And now in terms of sectors, as I mentioned there, luxury, the best performing sector of the bunch. Basic resources as a sector overall, trading about 0.6% higher. Autos, insurance, chemicals round out the top performers this morning. At the bottom, we've got healthcare, food and bev, real estate, media, utilities. So a little bit of a cyclical slant coming into the mix, but overall, the negatives outweighing the positives at the moment. Now, part of the negativity has come on the back of a warning we got from Philips. Let's take a look at that stock, which trades now about 8% lower. Philips has warned it will miss its profit margin targets for 2019 due to headwinds caused by trade tariffs. The Dutch healthcare firm revised its EBITDA forecast for the year, saying it expects margins to improve by just 10 to 20 basis points, far below its initial target of 100 basis points. Now, the company is sticking to its 2020 goal of 4 to 6% in comparable sales growth, but quite a stark warning on the impact of those tariffs and, again, adding a bit of a cloud around the trade war more generally. Now, looking again a little bit more closely at the action we saw yesterday, U.S. futures now have erased some losses after a White House official told CNBC a report saying China's trade delegation would cut short its trip to Washington was inaccurate. The South China Morning Post had said talks were deadlocked over forced technology transfers, prompting an early end to discussions. Meanwhile, the New York Times says President Trump will offer a concession on Huawei, allowing some U.S. firms to sell non-sensitive goods to the Chinese company. Eunice Yoon has the latest from Beijing.
Top U.S. and China negotiators will sit down tonight in Washington for talks, and investors are still unclear of the outcome. The New York Times is reporting that the Trump administration is close to granting licenses allowing American suppliers to sell certain non-sensitive components to Chinese tech giant Huawei, which the administration had blacklisted on national security grounds. But the South China Morning Post is quoting sources as saying Chinese negotiators plan to cut their visit to D.C. short by a day after deputies made no progress in their preparatory work. The White House has dismissed that report, telling CNBC that it's not aware of any changes to Vice Premier Liu He's travel plans. A senior administration official also told CNBC that dinner for the Chinese delegation is still on for Thursday night. Even so, expectations are low of a major deal. Overnight, President Trump said he wasn't surprised the Chinese didn't expect much.
I think they feel that I'm driving a tough bargain, but I have to. So I told that to President Xi. I said, this can't be like a 50-50 deal. Because a 50-50 deal, you're like up there, we're down here. So a 50-50 deal doesn't work, right? You got to have a little balance. This has to be a better deal from our standpoint. And I think they fully understand it.
The S&P reported that the sticking point is that the Chinese won't discuss forced technology transfers, a core demand of the U.S., while the Americans won't budge on keeping tariffs. The Communist Party paper, the Global Times, also didn't sound very encouraging, writing an editorial today saying they saw little signs of hope for a pleasant surprise at the talks. Eunice Yoon, CNBC Business News, Beijing.
Well, in addition to trade talks and all those comments, those conflicting messages in the run-up to today's high-level talks, we also had a close eye on yesterday's Fed minutes. At the Fed's last policy meeting, some policymakers sounded concerns over expectations for the central bank's rate path after the FOMC cut borrowing costs for a second straight month. Now, minutes from the September meeting, which were released yesterday, show, quote, a few participants worried that futures markets were pricing in greater accommodation than appropriate. Meanwhile, trade was mentioned 28 times, highlighting worries over the U.S.-China tariff war. Growth concerns were also highlighted, with policymakers voicing their fears that a slowdown could be more serious than projected. Now, at an event in Kansas City, Fed Chair Jerome Powell said he wanted to temper market estimates.
More firmly anchored expectations in a virtuous circle would help keep actual inflation around our target, thus preserving our ability to change interest rates as appropriate to meet our mandate. We're also looking at whether our existing monetary policy tools will be adequate when the next downturn comes. Finally, we're asking whether our communications practices can be improved to better support the effectiveness of our policy.
Now, minutes also showed several participants thought the FOMC should provide guidance on accommodative policy due to tariff concerns. However, that language was left out of the Fed's final statement after it cut rates in September. Now, the U.S. can impose tariffs on EU imports on October 18th following a ruling from the WTO. The decision comes after a 15-year legal battle over illegal subsidies given to Airbus. Willem raised the incoming tariffs with Italian Finance Minister Roberto Galtieri in Luxembourg.
Of course, we are not happy, and we will. It's not my job to deal with trade policy, but Italian government is addressing this issue both the bilateral level and the European level, because indeed it would be totally unfair to target Italian exports for an issue, by the way, about which Italy is not responsible at all.
Now, very pleased to say Jumana joins us live from the WTO in Geneva at the center of so many trade issues at the moment. Jumana.
That's exactly it. As you mentioned, Juliana, so many issues facing trade right now, not least the trade war, the tariffs, and of course that all-important decision last week, the largest arbitration decision ever taken by the WTO, giving the U.S. the mandate to impose up to €7.5 billion worth of tariffs on the EU. And with that, I'm very happy to say that I've got a guest with me, Luisa Santos, the Director for International Relations at Business Europe. Great to have you with us. I just want to take it back, actually, to the decision I just spoke about with regards to the Airbus subsidies, the decision that came out of the WTO. Are you worried that this is going to be a precursor for a trade war now between the US and EU?
Well, the decision is a legitimate decision. It was based on rules, existing rules. So now the question is whether the EU, what can the EU do to make sure it complies with these rules and make sure that the duties that are about to be imposed on European imports will be released. So we hope that the decision actually opens the door for a negotiation with the US, and that in the end we have an agreement on subsidies in the aircraft industry. I think that's the main objective.
Do you think it would be right for EU to go down the route of retaliatory tariffs, though, if, say, the US were in a month's time to make a decision on applying tariffs on the auto industry?
Look, we are talking about different topics. The EU has also a dispute on this ongoing Airbus-Boeing. The case is due in probably 5-6 months down the road. So if indeed that panel rules in favor of the EU will be able to, on its own, impose duties on US products. I don't know if they will do it at that time. Hopefully we will have a deal that solves this issue, this dispute that is going on for many years. The cars is a different topic. We still think that European cars are not the threat to national security of the US. This is a decision that is based on US rules, but in our view, this decision or these rules are not compliant with WTO. So we do think in this case is a different matter, and we don't think that EU cars should be subject to additional duties.
And indeed, if you look at world trade volumes, they've been falling off a cliff. WTO have revised down their outlook for this year of trade growth to only around 1.2%. Yeah. Do you think that this actually, the WTO bears some responsibility for allowing the environment to get so bad and so tense among some of the key economies like China, like the US, and like the EU now, and should have done something earlier to stop it getting to this stage?
The WTO has more than 160 members. It's a very complex organization. Decisions are taken by consensus, so one country can actually block a decision. Now, we might discuss on whether the system is the best, whether it needs to be reformed, and this is what we are now trying to think of ways of reforming the organization, making it more effective, more efficient, and that we have rules that are adjusted to today's trade reality. I mean, just mentioning about digital trade, climate change, I mean, all these are new challenges that the WTO might not be able to cope with the current rules. But we need to talk about reform and we need to do it. But it's important that we keep the system. We need multilateral rules because otherwise it will be the law of the jungle, and we will face even more problems on trade, even decreasing trade and also decreasing investment.
I want to turn your attention to Brexit and trade, and I also just want to take your measure on recent events because Donald Tusk has accused the Prime Minister, Boris Johnson, of playing a blame game and not actually wanting to achieve a deal in the first place. What is your take?
Look, the take from business is very clear. We want a deal. We think that no deal is the worst possible scenario. It will create disruption both in the EU27 as well as in the UK. We have been urging both sides to try to find a compromise, but of course, for the European business community, it's also important that we have certain principles that are safeguarded. And among them is the integrity of the single market. We don't want Brexit to put in danger the single market, and this is clear. But of course, we are still confident that a deal is possible and that we have an orderly exit of the UK from the EU.
And still, we're about 20 days away from that October 31 deadline. You represent and speak to all of these European businesses. Are they actually prepared for the worst-case scenario here, a no-deal Brexit?
We have been, for many, many months, asking companies to prepare. I would say a lot of them are prepared as they can be. But of course, being prepared does not mean that they will not suffer consequences and that there will not be disruptions, because there are still a number of uncertainties, and these uncertainties, of course, have an impact on how prepared you can be. So prepare does not mean that there is not going to be a negative impact.
Luisa Santos, thank you very much. I'll leave it there. There's Luisa Santos, the International Director of Business Europe. And as we just spoke about, many, many different issues hanging over the WTO Public Forum Conference, whether it's the subsidies, the tariffs, the trade war, all of these questions I'll be putting to Roberto Azevedo when I speak to him in about an hour and a half's time. So stay tuned for that interview. Lots going on here.
Jemana, thank you so much for bringing it, and I look forward to your interview coming up later this morning. Well, remember, you can follow us on Twitter at StreetScience if you want to weigh in on anything that's happening over in Geneva. Jemana just gave us plenty of food for thought there, or you can tweet me directly at CNBC Juliana. Well, we're going to take a short break, but coming up on the show, what a luxury. LVMH defies the headwinds. Find out more about the latest results after the break.
There's golf, and there's the golf lifestyle.
1 in 10 Londoners surveyed said they'll give more to charity in the next 12 months. Are you one of them? At CAF, we help generous people like you support their favourite charities by making giving simple. And we provide charities with the tools they need to perform at their best. So together, we can make a bigger difference for our communities. We're a charity and a champion for better giving. We are CAF, and we make giving count. Visit cafonline.org to find out more.
With school runs costing as little as 2p per mile, the electric car is now the car. Search Go Ultra Low to find out more. Cost based on Economy 7 and may vary.
Right now, the future is being written by people like you. Creative thinkers, tech lovers, problem solvers. Are you going to stand by and watch? Well, show the world what you've got. Join others around the UK on an EY degree apprenticeship in digital and technology. And earn a salary working with exciting businesses while studying towards a degree. Don't let the future pass you by. Get involved. For more information and to apply, search EY Digital Apprentice.
Time is money. Or so money says. Well, money. I know you like to dictate every hour of every day, add to my to-do list and throw the odd spanner in the works. But not anymore. This is my business, and I run it on my watch. I'm in control now, money. And times are changing. Save time with instant business invoicing, now on the Barclays app. Search Barclays Business and make money work for you.
Must have a Barclays business account. T's and C's apply. We could play epic music, or we could speak in an overdramatic tone, or even set off fireworks. But that's just not smarty. Instead, we let our offer do the talking. Right now, you can grab 25% off our unlimited data SIM. That's just $18.75 a month with no speed restrictions, no credit check, and no long contract to tie you in. Now that's smarty. Just search Smarty Mobile and switch today. It's easy. Offer available for a limited time only. See smarty.co.uk for terms.
At Cathay Pacific, we believe it's not about how far you've come. It's about how far you'll go. That's why ambition and innovation are at the heart of our story. Challenging ourselves to move beyond previous achievements and to move you forward in life. With state-of-the-art cabins, world-class entertainment, and award-winning service, you'll arrive ready to make the most of what lies ahead. Flying to over 70 destinations across Asia and Australia. Cathay Pacific. Move beyond.
Welcome back to Street Signs. Well, luxury firmly in focus today after LVMH posted better than expected third quarter revenue growth. The French luxury goods group said U.S. and European markets made good progress, while Asia also grew despite continued unrest in Hong Kong. And taking a look there at LVMH shares, it traded up about more than 4.5% so far this morning. Overall, luxury getting a nice boost from those results across the board. We're seeing pretty decent gains. Kering and Christian Dior, the best of the bunch beyond LVMH. Well, let's bring in Charlotte Reed, our French correspondent, for more on these results. Charlotte, it looks like a very strong set of results for LVMH. Give us the detail.
It is another beat for the group, and it's the world's largest luxury group. So, of course, all the investors were keeping an eye on their results when they published last night to see how the whole sector was doing, to give us a hint. And as I said, it's another beat. Organic revenue growth, 11%. That was above forecast. That was about 9%. So it was a great relief for analysts, for the sector there. Specifically on divisions, the fashion and leather goods had done particularly well, and that's the share, the lion's share for LVMH. It's about 40% of their revenue, and that division did extremely well. It was up 19% in organic growth. That was against forecast of 15%. And so Louis Vuitton bags, they're still very much in fashion, and also Dior as a brand itself doing really well, having a real momentum. Some analysts say it could be the new Gucci, the new brand that everybody wants to have. They had a really good first half of the year, and again the momentum seemed to have carried on in Q3. But other divisions, one in spirit, also doing well, with the premium brands in cognac and champagne doing well in the US in particular. Hard luxury also, which is usually more of a weaker spot, they're single out Bulgari, doing quite well. They actually said they had an excellent performance, so a few bright spots here for LVMH. The only slightly more concerning one, or slightly darker one, was selective retailing. That was only up 4% against 7% in Q2, and here we see the Hong Kong effect. They have Sephora that was absent from the Hong Kong market for about 10 years. They pulled out. They came back, they just opened a new shop, so a bit of a bad timing there for them. And also DFS, duty-free shop there. A lot of tourists coming to Hong Kong to buy luxury items. Hong Kong is about 5% of all luxury purchases in the world. And of course, the process here having an impact, and that duty-free store has been impacted, and it's mentioned in the statement by LVMH. But overall, they say, the geographical variety, the US and Europe doing well, so helping offset some of this impact of the Hong Kong protest. And there's a conference call this afternoon at 3 p.m. Paris time, so there will be much more questions on the Hong Kong protest effect and whether it's mainland China demand that helped offset this, but also more of a breakdown on whether the demand in Japan has been doing. But overall, a good set of results, and as you see, a lot of the luxury stocks up on the back of this.
Excellent. Well, thank you very much for breaking it down. Stay right there, Charlotte. We're going to bring in someone who's got a view on the luxury sector, Anne Lebonnier, Portfolio Manager, CPR Asset Management. Thank you very much for joining us this morning. So quite a strong share price reaction from LVMH as well as the broader luxury sector this morning. What do you think has investors feeling so reassured in last night's report from LVMH?
I think what is reassuring is the capacity of LVMH to sustain quite a resilient growth despite a more challenging environment given the slowdown in Hong Kong and tougher times in the US. So I think this is really reassuring. And I think the group is reaping the fruits of its star brand momentum, like LV and Christian Dior.
In terms of the impact on Hong Kong, we saw that overall Asia managed to grow. And yes, they did see some impact from the Hong Kong unrest that's been ongoing since June. But I'm curious, how much was the negativity in Hong Kong offset by stronger demand in mainland China?
We don't yet have the figures by geographic region, but we suspect that US may be stronger and China has offset part of the pressure in Hong Kong, and Japan was maybe a bit stronger ahead of the VAT increase coming. I think what is specific to LVMH is that demand currently exceeds supply in most regions, and that allows the group to better serve the demand in regions outside Hong Kong. And the fact that the group has invested heavily in digitals, in the brand's communication, also is a great driver of the demand for its brands.
I'm going to ask you, because we see all the luxury stocks up on the back of those results, but can we really extrapolate to the whole luxury sector? Or is it specific LVMH strengths? Because we know that the variety and the strengths of the LVMH portfolio with its 75 brands and the different sectors make it particularly resilient. Can we extrapolate really these good results from LVMH to the overall luxury sector?
It's difficult because we have different situations. Hermès maybe is the closest because it has demonstrated the resilience of its growth rate thanks to a very exclusive image, and we expect plus 12.5% organic sales growth consistent with the other quarter. So could be a positive read-through for Hermès. Regarding Kering is facing a normalization of its growth rate for Gucci. Gucci is still 80% of the group profit. And so the market expects Gucci to grow at plus 8%, facing a very tough base of comparison because in Q3 2018, the brand was growing at plus 25%. So Kering is in a situation of more normalization of its Gucci brand, but valuation for Kering is really, maybe attractive at 17 times next 12 months earnings versus LVMH with stand at 22 times next 12 month earnings.
And Anne, stepping back and looking at the whole sector, in terms of your preference, do you like the more dominant players or do you like the smaller brands that are trying to encroach on the incumbents' positions?
It's clear today that the bigger brands, the larger group, have the financial means to invest in digitals, in the remodeling of their store network, and so outperform significantly the smaller ones. And the bigger brands are able to deliver faster growth rate and faster organic growth rate, and are better equipped to post a more resilient growth rate in a slowing environment.
And LVMH in their statement said that they continue to be vigilant, and they've been distilling this message in the past few quarters, always saying they remain vigilant. And some analysts say this run that all these luxury sectors have had might have reached a peak. What's your view on that?
I think you always have cyclical elements in the luxury sector. But I will say that for the past few years, they have a more variable element of their cost base. They have invested heavily behind their brands, and they are in a better position to weather a slowdown versus the past few years. And the result posted today by LVMH as a good example of good resilience of their organic performance.
And thank you so much for joining us and weighing in this morning. Anne Lebonnier, Portfolio Manager, CPR Asset Management. Thank you very much, Charlotte, for joining us. Well, coming up on the show, Eurozone finance ministers agree a budget for investment and reforms. Our exclusive interview with Eurogroup President Mario Centeno next.
You're in charge of hiring, and Indeed has solutions, like online skills tests, which let a candidate show that they are the right hire. And we give you this toy monkey, who will bang its cymbals when the right CV appears on your desktop. Okay, there is no monkey. There is no monkey. But there are online skills tests.
See why more than 250,000 companies in the UK use Indeed for hiring. Visit Indeed.com/try today to try skills tests for free today. Terms and conditions apply.
Time is money. Or so money says. Well, money. I know you like to dictate every hour of every day, add to my to-do list and throw the odd spanner in the works. But not anymore. This is my business, and I run it on my watch. I'm in control now, money. And times are changing. Save time with instant business invoicing, now on the Barclays app. Search Barclays Business and make money work for you.
Must have a Barclays business account. T's and C's apply.
We could play epic music, or we could speak in an overdramatic tone, or even set off fireworks. But that's just not smarty. Instead, we let our offer do the talking. Right now, you can grab 25% off our unlimited data SIM. That's just $18.75 a month with no speed restrictions, no credit check, and no long contract to tie you in. Now that's smarty. Just search Smarty Mobile and switch today. It's easy. Offer available for a limited time only. See smarty.co.uk for terms.
At Argos, save up to 25% off furniture across thousands of lines. Our autumn-winter home and furniture collection is here. So stylish, you can wear it. With Argos, you're good to go. Offer ends the 22nd of October. Offer excludes nursery, bathroom and garden furniture. Conditions apply, subject to availability selected lines.
Fly from London Heathrow to Shannon from $55.99 each way as part of a return trip with Aer Lingus and experience something new on your next trip to Ireland. Discover the soaring cliffs and stunning scenery of the wild Atlantic Way. Explore the charming local towns and relax by the fireside with some traditional music and fresh seafood. Smart enjoys a short break in Ireland. Smart flies, Aer Lingus. Book now at airlingus.com. Offer subject to conditions and availability.
You're 169 in the queue.
I proposed on the 169. She got for the next stop.
Oh, you're my 169th greatest lover.
The number 169 never screamed going places until now. Get the Toyota Aygo X-Play for only £169 deposit, then £169 a month with 0% APR representative. Just go. Aygo.
0% APR representative on new sales of Aygo X-Play over 48 months. £169 per month. Customer deposit of £169 when proposed and approved via Access Toyota by 31st of October 2019. £3,487 and 50p optional final payment. Subject to status to over 18s. Indemnities may be required. Conditions apply. Toyota Financial Services.
Welcome back to Street Signs. I'm Juliana Tattlebaum. These are your headlines. Philips shares plunge after the Dutch health tech company warns trade tariffs will hurt the group's full-year margin targets. European markets turn positive despite China's foreign ministry calls on the U.S. to stop putting, quote, unreasonable pressure on Chinese companies amid conflicting messages on trade progress between Washington and Beijing. LVMH sets a trend after a third-quarter earnings beat sparks a rally in the luxury sector, easing concerns over the impact of unrest in Hong Kong. And Eurozone finance ministers agree a €17 billion budget for investment and reforms. Eurogroup President Mario Centeno tells CNBC the new package aimed at supporting the euro is now ready to go.
This will be at the core of the financing of the Eurozone today and in the future. And the instrument has been created, so it is fully operational. This is the important thing.
All right, well, we've got a raft of UK data just hitting the tape now. Let's kick off with UK GDP. GDP grew 0.3%. That's the 3-month versus the 3-month in August. 0.1%. That was the Reuters expectation. We are looking at minus 0.1% month-on-month versus flat growth. That's the month-on-month figure, and that's the first fall since April. In terms of year-on-year, it grew 1.1%. Versus expectations of 0.9%. So a little bit of divergence there. Now, other data we're getting come through, industrial output, that came in at minus 0.6% month on month, significantly worse than the market had been expecting. We were looking for 0.1% lower. The year-on-year figure for industrial output, that came in at negative 1.8%, again worse than expectations of 0.9%. On the manufacturing output front, that came in at negative 0.7% month-on-month versus flat month-on-month. So some negative numbers there on the industrial and manufacturing output front, but GDP, that beat forecasts in August and on track to avoid a Q3 recession. Now, in terms of trade, we also got some fresh figures on the trade front. The August goods trade balance came in at negative 9.8 billion sterling. That was a touch better than expected. We were looking at negative 10 billion. In terms of the total goods and services trade balance, that came in at negative 1.546 billion versus July, which was revised at negative 1.68 billion. And you're seeing sterling trading more positively this morning versus the dollar, up about 0.2%. Not much movement on the back of this data. It looks like a bit of a mixed bag, putting it all together. I mean, digesting, of course, GDP, which is somewhat backward looking, and then those are worse than expected industrial and manufacturing output figures. So a fairly mixed picture when it comes to this raft of UK data, but we will be keeping an eye on the sterling versus the dollar, of course, but currently holding steady at 0.23% higher versus the dollar. Let's take a look at European markets. So we have seen markets turn positive in the last minutes. The FTSE 100 is up about 0.04%. The DAX is up about 0.24%, and the CAC is now up half a percentage point. Within that, we've got luxury performing very strongly. We just broke it down with Charlotte before the break. LVMH reported a very strong set of Q3 sales last night, and that's providing a boost to the broader sector. Italy lagging the broader market, though, down just a touch below the flat line, but the message clearly things have turned more positive, and the highlight today for global investors are those high-level U.S.-China trade talks. Let's take a look at Forex markets and see where things stand. The euro much firmer versus the dollar, up 0.4% above that 110 level. Sterling now gaining some more ground versus the dollar in just the last second. So investors digesting that new data we got, the weaker industrial and manufacturing data, but slightly stronger GDP data, currently up 0.3%. And of course, Brexit front and center as well. Taking a look at U.S. futures, let's see where things stand. We're looking at a marginally weak start to U.S. trade. Yesterday, we saw a rebound on Wall Street led by technology. We, of course, had those Fed minutes come through. And now over the last 24 hours, a lot of back and forth, conflicting messages around where things stand on the trade front. But that is most certainly a focal point for investors as the day progresses. Let's zero in on what's going on with the Eurogroup this morning. Eurozone finance ministers have struck a deal on a 17 billion euro budget. Ministers have also agreed on a set of reforms that will come into place in 2021. Now, Willem spoke to Eurogroup President Mario Centeno and asked him whether the budget will have the necessary impact.
I think the most important issue coming out of yesterday's decision is that we have an operational instrument. Now we have to decide on the size, and that's up to the leaders to make that final decision. And then we have also a continuous discussion on adding external assigned revenues, resources to this instrument. So this will be at the core of the financing of the Eurozone today and in the future, and the instrument has been created, so it is fully operational. This is the important thing.
Centeno also warned of the potential fallout from a no-deal Brexit.
Well, the work we do on that file must be all directed towards having a deal. If it is by the 31st of October, okay. If it is after, it's okay as well, as long as we have a deal. No deal is a thing that we have to avoid at all times, now and in the future. So this is the biggest risk we face. It is a huge political risk that has huge economic and financial consequences, and we need to be aware of that.
Willem now joins us with more from Luxembourg. Willem, thank you very much for bringing us that interview with the Eurogroup president. I believe you're now with another voice to weigh in on what's going on over in Luxembourg.
That is right, Juliana. I'm joined by Nicolas Maquel. He's the CEO of Luxembourg for Finance. And we heard there from Mario Centeno, the Eurogroup president, about the risks of a no-deal Brexit. From your perspective, We've had a long time to prepare for a possible no-deal Brexit. It's been months since that last extension. Do you think finance companies here in Luxembourg are ready in case that happens?
I think the entire financial industry in Europe is relatively well prepared for no-deal Brexit, because that is exactly the scenario that they have started to prepare in the aftermath of the referendum, because that was the only scenario they could prepare for. They were hoping for a better result, but they did prepare for the worst, and that is a no-deal scenario. Now, it's not quite sure whether where we are going. We are 3 weeks away from the deadline, but it seems to be going into the direction of a no-deal scenario. But I think you have seen over the last not month but 3 years, many of the financial institutions announcing relocating activities to the centers like Frankfurt, Luxembourg, Paris, Amsterdam, Dublin, and others. The real question is what happens after a no-deal Brexit, and in fact that will show that a no-deal Brexit is not even a realistic scenario, because days, weeks or months after a no-deal scenario, somebody will have to get on a train from London to Brussels and restart those discussions about the future relationship, because it's simply inconceivable, whether it is in finance or in other economic activities, not to have relationships between the UK and the European Union single market. Anybody who thinks that lives in a parallel economic or business universe.
So let's talk about this in a bit more detail, because of course we hear a lot about the consequences for trade of a no-deal Brexit and what might then need to be done afterwards. We hear a lot about the consequences for the border on the island of Ireland in the event of a no-deal Brexit and what might have to happen afterwards. What do financial institutions here in Luxembourg and across Europe, do you think, want to see if there's a no-deal Brexit in terms of a resolution soon thereafter, once those talks you mentioned resume?
Well, what financial institutions have done since the referendum is set up alternative structures on the European continent. You saw quite a lot of reports of derivatives trading, investment banking going to Frankfurt and Paris, asset management firms choosing Luxembourg or Dublin, payments go to Luxembourg or Amsterdam or Dublin. What we really want to see after this has come to a term is discussions on how the City of London can still partner with the European Union. There were discussions on using equivalence as one. At one stage there was discussions about enhanced equivalence. Not sure how this will play out, because ultimately it's all a question of the political climate. It's all a question of the acrimony with which this will end.
Clearly this is a priority for financial institutions. Do you think this is still anywhere near the top of the agenda for the politicians?
It is certainly for the moment among the top issues, but if you ask any of the leaders in France, in Germany, and probably even in Luxembourg or in other countries, it is one among many issues. What we see is that in the UK, it seems to be all-consuming. Yes?
Okay, let's talk about Brexit in the past. Let's imagine a universe where we don't have to talk about it anymore. It's a road bump in the rearview mirror. What are the mountains the financial institutions in Luxembourg and across Europe that they have to climb, do you think?
Well, once we have solved Brexit, which, as you rightly say, is an operational issue for most of the financial institutions, there is another issue which is very much transformational for the financial services industry, that is digitalization, which really will change the way financial services will be delivered to customers. And then there is another issue which is not only transformational, which is existential, and that is sustainable finance. These are the two really generational issues that the financial industry has to tackle in the months and years to come.
Barely a week goes by where I don't see an email or a news alert talking about this bank looking to merge with this bank. Consolidation, clearly something a lot of financial institutions across Europe are considering. I wonder whether your members and some of the other banks you interface with across Europe give you the sense that this is part of that existential quest.
I think, obviously, if you look at it since the financial crisis, a lot has changed in the financial industry. Fees have gone down, costs have gone up with all the compliance costs, and thus, yes, of course, if you want to be efficient, you need to pool your resources, you need to consolidate, and that is what we see happening.
One final question then for you. You know, we had this result last night where all of these Eurozone finance ministers met here in Luxembourg and they agreed on what they call budgetary instruments, essentially a pot of money at some point down the road, not yet determined how large that pot will be, to try and help economies when there's a downturn. We're facing the prospect of a downturn at the moment. We're seeing signs in manufacturing data in particular, and some of the export-exposed economies, that things are not progressing in a particularly positive way. From the perspective of the private sector, financial institutions, do they think, those that you talk to, that government has done enough to prepare for the next downturn?
I think that if you ask the financial industry or any industry, they will always say no, more needs to be done. In fact, it is all a question of politics. Where does this negative sentiment come from? From much larger factors, indeed, geopolitics, trade tensions, and so on. I think what we now need to see, especially with the new commission taking office very soon, is really a drive to push this agenda and to help create growth in the real economy, and with that also in financial services, and also, for instance, push in the regulatory sphere with banking union, capital markets union, and the most important also, the digital single market.
We'll leave it there, Nicolas. Thank you so much for joining us this morning. That was Nicolas Makel. He's the CEO of Luxembourg Finance, making the point there, Juliana, that at a time of political transition here in Europe with the new commission set to take office in just a few weeks' time, it's also, of course, a moment of transition for the financial services industry here as well.
Very much so. Thank you very much, Willem, for bringing us that range of interviews. Now, Willem also spoke to Olaf Scholz, the German finance minister, earlier today, and he said that the EU must show that it worked hard to reach a Brexit deal.
It is absolutely necessary that anyone understands that there is a common responsibility to act. The European Union did the necessary things in organizing an agreement between the United Kingdom and the European Union, which has not been adopted by the British Parliament. And I hope that on the last meters there will be something which is a solution that follows the lines we have. Anyone knows that this does not work if it has any effect on the single market, on the customs union, and that we all know that the peace in Ireland is a top priority. The Friday agreement should not be endangered, and I think this is absolutely key for anyone, I think anywhere.
Meanwhile, Cyprus's finance minister said he believes governments and businesses are ready if a Brexit agreement cannot be sealed.
Our government, and I would say most governments, probably most companies, most corporates, by now are as prepared as they could have been, even for a no-deal Brexit. And this very fact that it's the baseline scenario now probably makes Brexit less of a risk than it was a year or two. So if an event doesn't have the sense of crisis or a sudden event, and it's something that we more or less see it coming and we are ready for it, prepared for it, well, it doesn't mean that it's not a negative development, but not maybe as bad as it could have been a year ago or two.
For more from Luxembourg and the growing frustration among EU finance ministers over the ongoing Brexit deadlock, head online to cnbc.com. Meanwhile, ECB President Mario Draghi reportedly ignored advice not to restart the central bank's bond buying program last month, according to the FT. The paper cites sources who say Draghi received a letter from the central bank's Monetary Policy Committee members urging him not to resume the bond purchases. And there you can see the euro is rallying very strongly versus the dollar, up about 0.4%. Perhaps this suggests that Madame Lagarde at the ECB, when she takes over, will face a pressure to abandon Mario Draghi's policy of further easing, given where rates are already. Well, Well, if you were planning to watch the rugby on Saturday morning, I'm afraid I have bad news for you. England's Rugby World Cup match with France has been cancelled due to Typhoon Hagibis. The typhoon is set to hit Japan on Saturday, and organizers have also cancelled New Zealand's tie against Italy. Ireland's clash with Samoa is going ahead as planned. Now, according to tournament rules, a cancelled game is recorded as a 0-0 draw, and both teams are awarded 2 points. So that means England would go through to the top of Pool C, with France in second place. So far, all 4 games on Sunday, including a crucial clash between Scotland and Japan, remain unaffected, but a decision will be made on Sunday morning, so stay tuned for that. Well, coming up on the show, there was no blackmail. Ukraine's president speaks out about a controversial phone call with President Trump. More after the break.
During your first Inspirato vacation, you'll notice that something is different.
Time is money. Or so money says. Well, money. I know you like to dictate every hour of every day. Add to my to-do list and throw the odd